At the precise moment of this analysis, NVIDIA Corp is trading at $179.39, down $1.25 on the session, representing a fractional decline that belies the absolute storm of activity occurring beneath the surface of the order book. While the headline number suggests a mundane consolidation day, a simple breather for a stock that has become the engine of the modern market, the reality is far more complex and, frankly, far more dangerous for the uninitiated investor who is simply looking at a green or red arrow on their phone screen. Most market participants, especially those skimming headlines on their Robinhood app or checking their SoFi Invest dashboards, are operating under the expectation that a company beating revenue estimates by billions of dollars should immediately skyrocket, printing new all-time highs and rewarding every call option holder with instant liquidity. The expectation is linear. Good news equals higher prices. But the reality we are witnessing today is a masterclass in institutional distribution and the sell the news phenomenon, compounded by a geopolitical subplot involving the Department of Justice that most retail investors haven't even fully digested yet. We are seeing a divergence between the company's operational excellence, which is undeniable, and the stock's mechanical ability to absorb liquidity at these stratospheric valuations. You are looking at a price of $179.39, not because the company failed, but because the market is currently asking a much more difficult question. Exactly how much perfection is already baked into this price? And what happens when the whisper numbers, those unofficial expectations held by the desks at Fidelity and Interactive Brokers, start to outpace the reality of physics and supply chains? To understand why the stock is red today, despite the recent earnings beat, you have to look at the flow of funds happening in the dark pools and the block trades being executed by the major prime brokerages. The tape is telling us that while retail investors are still buying the dip, likely using fractional shares on Robinhood or adding to their positions via Schwab Intelligent Portfolios, the institutional smart money is using this liquidity to trim their exposure. It is not a panic sell, far from it, but it is a disciplined rebalancing. When you manage billions in Fidelity mutual funds or Fidelity ETFs, you cannot simply dump shares whenever you feel like it. You need a catalyst of high volume to exit without crashing the price. The recent earnings report, which showed revenue hitting a staggering $57 billion, provided that liquidity event. The retail expectation was that the beat would trigger a squeeze to $200. The reality is that the beat was the dinner bell for institutions to lock in profits from the last 3 quarters. This creates a curiosity loop for us. If the greatest company in the world can't go up on the greatest earnings report in history, what does that tell us about the remaining buyers? It suggests the buyer pool is momentarily exhausted. We are seeing a classic compression pattern on the intraday charts, where every attempt to push back above $180 is met with a wall of limit sell orders, creating a ceiling that feels made of concrete. This price action is frustrating for the bulls, but it is technically incredibly healthy. It effectively flushes out the weak hands, the leverage-heavy speculators who entered late, and transfers that ownership to long-term holders who are willing to wait out the consolidation. However, there is a deeper, darker narrative pressing down on the stock today that goes beyond simple profit-taking, and this is where we strip away the corporate gloss and talk about the gritty reality of being the world's most important strategic asset. Just recently, news broke regarding federal charges against individuals involved in a smuggling ring designed to funnel NVIDIA's advanced chips into China, bypassing strict U.S. export controls. We are talking about a scheme involving a front company in Tampa, ostensibly a real estate firm that never sold a single house, being used to traffic high-end GPUs. This isn't just a spy novel subplot, it is a material risk to the company's supply chain security and regulatory standing. While investors on Interactive Brokers are worried about the daily RSI or the moving averages, the compliance officers at major sovereign wealth funds are looking at this DOJ indictment and calculating the risk of further crackdowns. If the U.S. government decides that NVIDIA's chips are too difficult to police, they could theoretically tighten export restrictions even further, cutting off valid gray market revenue streams or imposing burdensome chain of custody requirements that slow down logistics. This is the tension I mentioned earlier. The expectation is that demand is infinite and unhindered. The reality is that NVIDIA is operating in the crosshairs of a Cold War, where their product is treated less like a computer part and more like weapons-grade uranium. This geopolitical friction acts as a constant drag on the multiple, preventing the price from expanding as freely as it did in 2023. Let's pivot to the actual mechanics of the recent movement. The stock is currently hovering just below the psychological 180 level. In the last trading session, we saw a significant volume spike at the open, followed by a slow bleed, a pattern known as distribution. This usually indicates that while the morning news brought in the enthusiastic crowd, perhaps those engaging in online investing for the first time, the afternoon was dominated by methodical selling. We are seeing support forming around the 177 mark, a level that technical analysts would identify as a crucial pivot point. If 177 breaks, the algorithmic trading bots that dominate the high-frequency space could trigger a cascade of sell orders targeting the next liquidity pocket down around $165. Conversely, the bulls need to reclaim $185 with conviction to invalidate this bearish short-term setup. It is fascinating to watch the tug-of-war between the options market and the equity market here. The gamma exposure is massive, meaning that market makers are forced to hedge their positions aggressively as the price moves, which exacerbates the volatility. When you see the stock snap back and forth by $2 or $3 in the matter of minutes without any news, that is often the result of these hedging flows, not fundamental changes in the business. It is a game of 4D chess played by supercomputers, and as an individual investor, your best defense is to understand that the intraday noise is often just math resolving itself, not a verdict on the company's soul. Speaking of the company's soul, we must address the sheer scale of the numbers NVIDIA just posted. Expectation? AI demand might be cooling as companies struggle to find use cases. Reality? NVIDIA just posted $51.2 billion in data center revenue alone, up 112% from a year ago. Let that sink in. They didn't just beat the number, they obliterated the concept of a ceiling. The Blackwell architecture, their newest chip design, is reportedly sold out well into the future. We are hearing anecdotes of hyperscalers, the Microsofts, Googles, and Amazons of the world literally begging for allocation. This is not a demand problem, it is a physics problem. The limiting factor for NVIDIA right now is not finding customers. It is the physical capacity of their manufacturing partner, TSMC, to package these complex chips using CWOS, chip-on-wafer-on-substrate technology. When you analyze Tesla stock, you worry about consumer demand for cars. When you analyze Apple stock, you worry about iPhone upgrade cycles. When you analyze NVIDIA, you are effectively analyzing the global supply chain's ability to rearrange silicon atoms fast enough to satisfy an insatiable hunger for compute. The company has effectively become a utility, the electric grid of the 21st century. But here is the contrarian take that might make you uncomfortable. Being a utility is great for cash flow, but it eventually leads to utility-like growth and utility-like regulation. We are not there yet, but the law of large numbers is starting to kick in. Growing 100% a year at $1 billion revenue is easy. it is statistically improbable at $200 billion revenue. The market is sniffing this deceleration out, which is why we are seeing the PE ratio compress even as earnings rise. I want to pause here and ask you a question that really matters for your portfolio strategy. Comment below with your honest take. Do you think the government will impose stricter regulations on AI chip exports in the next 6 months? And if they do, are you holding through the volatility? I'm seeing a lot of debate in the forums about whether this is a sovereign risk or just noise, and I want to know where you stand. Now, let's look deeper into the competitive landscape because the expectation is that NVIDIA has no competition. The reality is that the competition is forming, not from rivals like AMD or Intel, but from NVIDIA's own customers. Amazon has Trainium, Google has the TPU, Microsoft has Maya. These companies are spending billions to design their own custom silicon to reduce their reliance on NVIDIA's high margins. While NVIDIA's CUDA software moat is currently wider than the Pacific Ocean, making it incredibly difficult for developers to switch away, the massive capital expenditure being poured into alternatives is a long-term threat that cannot be ignored. If you are holding this stock,